Good morning, everybody. Welcome to the annual San Jose State University Economic Summit, with our presenting sponsor being Bridge Bank, associate sponsor Hopkins Carley, our affiliate sponsor San Jose Chamber, and our media sponsor Silicon Valley Business Journal. So huge thanks to all of our sponsors today. We have been 100% virtual the last 2 years. Today we are mostly virtual, but we are actually all in one room together with a few select others observing, so we'll call this a hybrid event today. And so for those watching on Zoom or on YouTube, welcome. We're delighted that you're tuning in. It should be a fantastic event. And just want to remind folks, a couple of years ago, the San Jose State University commissioned an economic impact study. And the university to the state, at least in the year of the study, 2018-19, had an economic impact of $4.1 billion. Of $2.4 billion of that actually went or impacted the Bay Area. So we are a significant economic player, if you will, in the Valley, and are proud of that, and are delighted to have the opportunity to, again, present this event and share some insights on the year ahead. So, with no further ado, please join me in welcoming the CEO of Bridge Bank, Dan Myers.
Thank you, Dean Mashavi. Good morning and welcome to you all, both in person and virtually. Bridge Bank is pleased to be the presenting sponsor of this year's Economic Summit, as we have been for the last dozen years since co-founding the event with San Jose State University. We also need to again thank the other three co-sponsors, Hopkins Carley, San Jose Chamber of Commerce, and the San Jose Silicon Valley Business Journal for bringing this event to you. A little bit about Bridge Bank. We were founded 21 years ago right here in San Jose. That means we're local to all of you in San Jose and the Bay Area. We've had our measure of success over those past 2 decades. Now, as a member of the Western Alliance family of businesses, Bridge has expanded to 15 offices nationwide, soon to be 17, and brings a $60 billion balance sheet to meet the needs of our business clients. Our mission is, and always has been, to support our clients to succeed. Helping them to navigate that path to success necessarily begins with understanding the fast-changing economic and business landscape. And that's why we're all here today. We hope that today's program will provide you with a clearer understanding of all that's going on in these very unique economic times. We're pleased to be your neighbor and local business banking resource, and we hope you enjoy today's program. And with that, I'll turn the podium back to Dean Mashavi, and thank you again for attending and for your kind attention.
Thank you, Dan. It's now my pleasure to introduce our first speaker. Alan Cohen is a partner with DCVC. Alan brings entrepreneurial and operational expertise to DCVC portfolio companies, particularly in product development, go-to-market, and growth. He's an executive with hands-on experience running large enterprises as well as startup companies, and his past 3 ventures created over $3 billion in aggregate value. Please join me in welcoming Alan Cohen.
Good morning. It's a pleasure to be with everybody, including some folks live. This is the first time I've stood in front of a podium in 3 years, so if I'm a little rusty, you'll have to cut me a little bit of slack. Thank you. When Dan asked me to join the forum this morning, he asked if I would give a bit of the venture perspective. And I said, okay. And then as we got closer, I realized I was actually supposed to put together a presentation. And it forced me to do a little bit of homework, which is something in our industry, venture, that we pride ourselves on. And it gave me some very interesting insights into where the state of the venture industry is, particularly here in the Bay Area. And I hope to share some of that with you, and then we'll tease it out a little bit more as we go through the Q&A afterwards. So just a little about me. I'm not from here. I grew up in this little part of Brooklyn called Coney Island about 175 years ago. And later, and spent a long part of my career, actually, first part of my life, getting educated. And it took a lot of times to do that. Didn't stick the first couple of times. So I've gone to school around the country and then ultimately made my way into tech. And I started at some fairly large tech companies. I worked for a phone company in Denver. Remember that we used to have phone companies. We had a phone company here in California called Pac Bell. It's now part of, everything's actually other AT&T and Verizon. And then worked for some of the large tech companies during the emergence of e-commerce, the birth of the internet, and then various areas. For the last 3.5 years, I've been part of DCVC, which is also known as Data Collective. It is a deep tech venture capital fund, and I'll explain what that means in a moment, but we effectively invest in the intersection of what I would say is deep science and then computational advantage, such as AI and those areas, and that's principally where our focus is. I think every presentation, particularly I'm the chairman of a publicly traded company, should have a forward-looking statement. This is mine, and just to let you know, my background, I actually have 2 graduate degrees that are based in economics as well. It's an interesting profession. It's actually an important one, but it also doesn't always get things right. When you look at the last couple of years, particularly here in the Bay Area and in the tech industry overall, we have a real paradox that has gone on. So on one hand, we've seen more global disruption than any of us could have anticipated 10 years ago. We have seen a horrible virus, not to be seen in many decades before. We have seen the effect of environmental degradation and global warming, whether it's fires here in California, floods in other parts of the country. We've seen a war emerge in the last 6 to 9 months in Central Europe, something we never expected to see. And we've seen a wave of social activism, starting particularly with George Floyd, right? So some fairly interesting societal drivers. In the backdrop of that, if you look at the NASDAQ over these last couple of years, we've also seen one of the largest rises in history. So there's a very interesting decoupling or paradoxical look between of what's going on in our society and what's going on in our economy, or certainly the economic manifestation of it in the market. And then obviously we've seen since the beginning of the year deterioration of stock prices, as we all know. And my advice is not to log into your 401k every day. It's not a healthy thing to do. Stay off of Twitter, stay off your 401k, you're going to have a much better day. So I started to dig in a little bit more and look at my industry, the venture industry. And by the way, I've only been a VC for 3 years, so I like to say I only play one on Zoom Monday to Friday. I see myself as somebody who's done 4 startups in a row and builds companies, but I can't get away with that line anymore. I'm actually one of them. I am actually in the venture industry. So if you look in the last 5 quarters, what you'll see is that in 2021, we effectively saw a doubling of venture capital deployed in the United States. These numbers are from PitchBook, which is kind of the Bible of our industry, and obviously a tail off in Q1. Now, if you plot this more like an economist, what you realize is there was an enormous push into venture, unheralded amount of fundraising and money put to work. And obviously, it led to a huge increase on the right to the number of deals that were executed in the market, meaning venture capital money put into new companies, and that trailed off, of course, in Q1 as well. The interesting thing is if you plot it out, we're actually still on a fairly linear curve and fairly smooth. The difference is in 2021 in that growth area, little under half, about 43% of the dollars in deal flow actually went into crypto. So 2021 and 2020 before that was really the era of crypto in our industry. And I didn't want to make the chart too belabored, but if you look at 1999 to 2001, there was an enormous amount of money put into broadband, e-commerce, and other areas. Not all of those businesses made it. However, they provided a form of infrastructure that allowed globalization and the economy to thrive. So I tend to be more of an optimist, and I believe that while we're probably not going to be replacing the fiat currencies, probably a good thing not taking down the financial institutions of our country, that much of the technology and thinking that has gone into crypto and centralized finance are actually fairly interesting building blocks for a bunch of industries. So, the question you have to ask yourself is, are we seeing a big fall off, or are we actually seeing more of a return to norm in the industry? A couple of other things to think about. If you are in my industry today and you're dealing with late stage companies, there is some real tension, right? And there's been a lot of layoffs in some of the larger, later stage companies. There's questions about market valuations that obviously went with that inflation. But I think we all have to remember that the value of private companies is directly correlated to the value of public companies, because more often than not, public companies acquire successful private companies. Some of them do make it out the door, and many of them did in SPACs in late 2020 and 2021. What that means is that people in my industry have shifted more to the left. They've looked much more at earlier stage companies that are just getting formed, whether they are seed deals or even pre-seed deals, angel deals, and we've gone through an enormous market segmentation. There's now pre-seed funds, post-seed funds, angel funds, right? So we've actually created all this market segmentation. And what that's meant is for the good companies, actually pricing has gone up. Some of that has to do with economic factors, including things like salaries, which basically go to pay landlords and mortgages, as well as people wanting to start earlier in the cycle, have larger ownership stakes in the industry. So if you look through these things, I think it's fairly logical what's going on. It's despite much of the concern. Many of you may be familiar with this document that just emerged a couple of weeks ago. This is the cover of the Sequoia Memo, which is called Adapting to Endure. And to kind of net it out, right, the advice, which is quite good advice, and Sequoia is a premium investor in our industry, effectively kind of the Golden State Warriors of venture in the last 10 years, they're saying be careful with your capital. Be smart, be well capitalized, don't waste money. Get rid of unnecessary expenses that you don't need, which is not actually, I think, very radical advice. I think it's very rational advice for companies. And, coming out of the exuberance of the crypto era of the last year, of the giant increase in the stock market, I think it's more of a healthy pause on expectations. A couple of other factors that are worth paying attention to, we all care about. So increasingly, there's competition for leadership in tech. I couldn't resist this. I'm going tonight. Yes, I am. I'm a season ticket holder. And if you think about it, we have seen other states and other other cities around the country that have emerged as real tech hubs. Clearly, the Bay Area by dollar-wise and economic activity is number one, right, by and large, right? So we're still Steph, Draymond, Clay, and the gang competing, but Miami has shown up as a hub. By the way, I love that it's Miami and Boston. Boston's always been strong. New York is increasingly becoming a capital of financial services, 2.0, 3.0, 4.0, which is not surprising. I have this phrase, render unto JP Morgan what is JP Morgan's, right? I mean, New York is going to play a role in the next generation of finance. And then Dallas, and a lot of people have moved to Austin for barbecue and at one point in time, more effective housing prices. But so there are kind of two things that I think have happened that we all have to pay a lot of attention to. One is we've seen a dispersion of tech talent into these geographies, as well as capital formation and company building. And then secondly, based on the pandemic of COVID, we have seen the acceptance of remote work. And that is a huge factor that is going to change how we run companies and build value going forward. A lot of companies, we have a company here in the Valley called GitLab that went public last year. That company started as a remote work software company. They build repositories for people who are building code. They don't have an office. They've been remote since day one. May not be great just to be in front of your computer all day at home, but there are a lot of people who want to do that. The other factor, which maybe we'll see whether it swings back, there's been a bargaining power change where labor, particularly in the tech industry, is in charge more than capital. There is millions of tech jobs available, and they have been forced to accommodate people remotely. I happen to like going to office, but in my career, I used to work for this little company called the US government. I worked for a phone company. I worked for IBM. I worked for Cisco. Then I worked for a bunch of startups, and now I work for venture firms. So I'm in an office 1 day a week, and 4 days, the rest of the days of the week, it's me and the dog and my Macintosh doing our job when I'm not traveling. So I think we have to pay attention. One good bright note, I think people should, if you pay attention to the data, there's been an enormous increase in the amount of venture capital dollars that have been deployed in this country. So 9-10 years ago, it was about $27 billion, of which the Bay Area had roughly a third coming to this area. Now, people are decrying that we're down to 27% of all venture dollars, but that's on a base of $329 billion. So there is more capital flowing through the Bay Area than there ever has been. And if you are somebody trying to rent a house, buy a house, or rent an apartment or something, you will understand what that means in the terms of housing costs. Some other kind of considerations when we think about what is going on now. Many of us have been in this industry for a while. And I would posit that much of the infrastructure of tech, the industry that we grew up with, the Hewlett-Packards, the Intels, the Ciscos, they're fairly mature industries. The IBM PC was released in 1981. It's hard to believe that Cisco went public and came out in 1986, which effectively created the infrastructure network routing that we all count on. Netscape is 27 years old. Turns out, those guys are not as young as they used to be. The iPod is a 21-year-old device, and Amazon, not Amazon, the e-commerce business, but Amazon Web Services, the infrastructure that increasingly companies use to run their computing, is actually 17 years old. So we've seen a big change, and you have to ask yourself economically, when industries start to mature and when they grow slower, what happens? Well, one, they tend to focus more on margin, right? We see that because they are publicly traded companies and they are responsible to their shareholders, but they also and that means they start to look at costs. So increasingly, companies that are not growing quickly, Apple and probably Amazon are obviously the exception. Some of these are not as relevant. They tend to distribute their workforces and their innovation. And that's a natural effect. I mean, we stopped building all of our cars in Detroit by the 80s. Most of the cars in the US are actually built in the South. They're not built in the Midwest. They still build a fair amount of cars there. We saw manufacturing move to places like China. We saw outsourcing industries move to places like India. So when you see the slowing of the tech industry, you have to think about whether you'll be looking for them as the same engines of growth here in San Jose. And I would posit probably not. You have to look in other areas. So let me kind of shift a little. So for the last year, 18 months, a lot of people have been talking about this stuff as the future, right? Cryptocurrencies, coins, and NFTs. And if you're not familiar with the Bored Ape on the bottom, that is the symbol of an industry which was based on taking an asset, assigning a token to it, and allowing people to buy partial ownership. Think about it like timeshare for maybe not Picasso, but other forms of art. And we've obviously seen a huge crash. There was $1 trillion lost in cryptocurrencies in the last 6 months. I'm not very surprised, right? There's nothing that really backs them. They are a self-induced phenomenon, and they are a I don't know, induced or deduced or changing phenomenon. With that said, much of the technology that comes out of this move I think is actually fairly valuable and people are looking at very carefully. But if I'd say what was the big tech move in the last couple of years, sorry, I skipped ahead, I'd actually say it is on the right, and that is a pictorial view of how messenger RNA works. For most of us, or almost all of us probably who are vaccinated, the ability to create a vaccine to deal with a global pandemic, and while we had enormous death and people that were sick and a disruption to our economy, we also have saved hundreds of millions of lives. The sequencing for the vaccines, whether it's Pfizer or Moderna or J&J or the others, literally happened over a course of weeks and then went into a 6-month trial period. So to me, the most powerful computing that we have seen was actually the use of machine learning and hard science for creating a vaccine that has helped our lives get back to some form of normalcy. And so when you're thinking about being an investor in this space, you have to say, well, stuff on the left is kind of speculative. The stuff on the right kind of really matters. And that's what I do and my firm does. And I would suggest that when you look into the future of Silicon Valley, the future of San Jose, if you can't look to the maturing industries of enterprise tech or even consumer tech, where do you look? So the overall tech economy is about $4 trillion worldwide. The rest of it is about $86 trillion. And most of it has not had its digital revolution. It has not had, they innovate tremendously. There's been robotics and there's been synthetic biology, but the ability to use computing power to go after these industries is fairly amazing. And whether it is in agriculture, whether it is in supply chain, whether it is in protecting ourselves, whether it is the creation of new energy forms, and you're going to hear a lot out of Silicon Valley about nuclear power over the next couple of years. Which, I personally believe you are not going to be able to address our energy needs and the electrification of our economy unless actually nuclear power is made to be safe and ubiquitous. So you have to start to really relook at the industries as opposed to being the 10th company to build a visual spreadsheet to track the movements of salespeople. Right? And then I think that's what we need to do. So I want to share just a couple of examples of companies here in the Bay Area. Now, caveat emptor, we are investors in all of them. So, a little marketing moment for my firm. The first is a company called Pivot Bio, which was founded by a team out of Berkeley. This is effectively a microbial replacement for chemical fertilizer. Chemical fertilizer is a $250 billion industry. That is larger than networking, servers, PCs, and storage devices. And without it, we don't have food, right? Nitrogen-based chemical fertilizer based on the Haber-Bosch process has created food for billions of people. The challenge, however, is that it burns out the soil and it puts nitrogen oxide into our water and into our air. So it needs a bit of an overhaul. Pivot Bio this year is going on to billions of acres of wheat, sorghum, corn, and other crops. And what it effectively does, this microbe, it actually leaches nitrogen for the soil, so you do not have to pour chemical nitrogen fertilizer, ammonia-based fertilizer, on crops. Not only does it actually effectively provide a more effective approach from an environmental point of view in greenhouse gases, it actually provides corn that tends to have a yield of 10 to 15% higher. And I've actually spent a lot of time with this company. It turns out farmers are really smart about this. So the future of, and you can't really have agriculture without fertilizer, is actually being built in labs in Berkeley. You wouldn't think about Silicon Valley as a leader in agriculture, but we are. Another company, Freenome. Freenome is a company that is based on a whole mess of machine learning, has figured out how to do early stage colorectal cancer testing, and they'll be working on other cancers, through blood tests. And if you have as much gray hair as I have, I've been now through 2 colonoscopies, and never thought I'd ever be on a stage talking about that. If anybody knows what the warm-up day before that is like, it's not an experience you want to repeat. But what this means is if we can actually do things like blood testing, we can test people earlier, and increasingly we're recommending this testing is being done earlier. We can make it much more less invasive. We can increase people don't have to take a day off from work for getting ready for that. And it's fairly amazing. There's another company based here in Silicon Valley. 12. This actually is one of my favorites. 12 is a company, also actually comes out of Berkeley, that is actually taking waste gases, waste CO2, particularly in manufacturing plants, and it is turning into reusable molecules and materials. So they're still relatively early, but they are working with P&G on Tide, not Sheer, but Tide, right, with Blue Flakes, the most important detergent, and a huge profit center for the Procter & Gamble company, with NASA and the Air Force on jet fuel and on parts for cars. And so they are effectively taking what we used to see as pollution and turning it into products that we can use across our everyday lives as we live, work, learn, and play. Fairly amazing Bay Area company. And then maybe a fourth one that I'll close on, Caption Health, and this is a company I'm actually on the board of. They've done something really remarkable. Anybody in the room ever had an ultrasound? Show of hands. Okay, about half, more than that, right? Ultrasound is one of the most effective diagnostic tools in the world. It's used across a range of things, whether it is hearts, lungs, maternity, orthotics, orthopedic. The challenge, however, is you have to be fairly skilled to use one. And that creates a shortage. There's actually a shortage of sonographers who operate this, or doctors. What they have done is they've used AI to actually guide an individual to take a scan, let's say an EKG or arterial sclerosis scan of the heart, for example, and it will capture the image, which then could be read by a doctor, increasingly can be read by actually software. And the thing about it is it does it on a handheld device, and you don't have to be trained. It is the equivalent of an Uber driver following the arrows on their iPhone when they're taking you from point A to point B. That actually changes the model, because we can now deliver point of care and preventative care directly to individuals, as opposed to making you drive to the clinic or the hospital, even worse. And the more preventative care we do, particularly in a population that is aging, or a population that is still trying to understand the impact of long COVID on people's hearts and lungs, at a fraction of the cost. They're actually, so they've done some really remarkable things. So in concluding, what I would say to think about is that as we, folks that are extremely invested and care deeply about the economy of the Bay Area and of San Jose in particular, because we are at the San Jose Economic Summit, I would suggest that it's worth really examining where these new areas of fairly giant industries are emerging, and seeing where we can play a role. Thank you very much.
Thanks very much, Alan. Really appreciated the comments. Now, delighted to introduce our next speaker, Christopher Thornberg. Chris is the founder of Beacon Economics about 16 years ago. Under his leadership, the firm has become one of the most respected economic forecasting firms in California. And Chris also is the director of the UC Riverside School of Business Center for Economic Forecasting and Development, and is also an adjunct professor at the school. Please join me in welcoming Chris Thornberg.
Appreciate that. Oh yeah, it should be just okay. Do that for me. Good morning, everyone. Oh, come on, really? I waited all this time for a live audience, and that's the best you can do for me? Morning, Chris. Yeah. It's modestly better, but I won't push it. It's obviously lovely to be back. I wish you could all be in the room here, but it's nice to see a certain number of faces. And interesting, obviously, I'm not sure that you would have anticipated having back-to-back speakers who both have SUNY Buffalo roots. I did my undergrad there as well, as the case may be. I'm from Western New York. Yeah, well, there you go. We go, well, maybe not. Maybe not as many years as you think. Yeah, like, wow, what a crazy couple of years. And you know, it's funny, I will tell you, God, we've been doing this for like 10 years now. In fact, one of the things what is this thing? There we go. You know, one of the things, of course, that we are distributing our South Bay Regional Intelligence Report that we've done, of course, in concert with Bridge Bank for any number of years now. And I'm back here, obviously, giving a talk about the economy, where things are going, why they're heading there, all this kind of stuff. And you know, it's interesting. I sort of remember in 2019 being up here, and I'll be blunt. I was getting a little bored of myself, which is an odd thing to say, but honestly, my forecast from 2012 to 2019, if I had to sum it up, can be boiled down to basically, no, it's fine, really. That's all we talked about. It's fine, really. Now, what's interesting about that, of course, is the last couple of years have not been fine. And where our economy is today is a function of, yes, of what has gone down over the last couple of years, but maybe not in the way you think. And, of course, when you think about where our economy is today, it's a lot different than where it was a couple of years ago. But, I want to start out with this. This is last December, which is a few months ago now, but it is intriguing. Good morning. Why do Americans say the economy is in rough shape? Because it is. Now, what's interesting about this headline is it almost takes me back to the pre-pandemic period. And, of course, this has been intensified lately. I'm not sure if you caught some of this stuff. Housing market just slid into a full-blown correction, says Mark Zandi. Gas is $6 a gallon. Recession odds now at 30%. Jamie Dimon just came out, this is yesterday, is bracing itself for an economic hurricane. Wow. Scary stuff, right? And of course, oh my God, I know what's going on here. So, I'm sorry, my slides are giving me conniptions here. Let me try this a little differently. Look, if you think about where our economy is today and what all the current panic is about, it obviously boils down to this graph right here, which of course is the increase in rates we've seen, and of course the increase in inflation. The CPI was a little above 8% at this particular point in time, highest number obviously in 40 plus years. Mortgage rates just crossed the 5% range, and of course we've had 3 quarter-point rate hikes from the Federal Reserve, and, well, this has got everybody hot and bothered, right, to say the least. Everybody, of course, is responding to this. They're talking about how dramatic these returns are. But then again, let's think a little bit about the pessimism that's starting to dig in at this particular point in time. Take, for example, the stock market, which has come down pretty strongly in the last week. I think they call it, we've officially moved into a bear market range, as the case may be. But to be clear, if you see where we were at the end of last month and you did your kind of 3-year returns, even with the big sell-off, NASDAQ, for example, is up almost 15% per year, even with the sell-off we've seen over the last 3 years. S&P 500 is up 12%. The Dow Jones Industrial is up 8%. My real question is, did anybody really think the gains in the stock market over the last couple of years were sustainable? I mean, I'm sorry, but when the market explodes like that, of course it's not sustainable. Of course it's going to go down. And of course you've seen an increase in that next recession survey, now a 30% chance. But it's worth noting prior to the pandemic, that number had reached almost 40%. And I still remember in January 2019 when 80% of economists who contributed to the Wall Street Journal Next Recession Survey said we were going to have a recession by the end of 2020. Now, mind you, in January 2019, no one was talking about COVID, folks. They were talking about the Chinese trade war, the real estate meltdown, the increase in interest rates because mortgage rates had gotten to 5%. In other words, really honestly, is there anything particularly new with all these sort of, what do they call them, the nattering nabobs of negativism screaming about the end of the expansion? This is kind of standard. I mean, Zandi, housing is now a market correction. This is the same guy who told us a couple of years ago that because of the pandemic, 15% of homeowners were going to get foreclosed on. My question is why is he even in the paper anymore? I mean, honestly, it's crazy, right? Now, I'm not saying, of course, that everything's fine. I am really worried about the economy. I'm very worried about the economy, but I'm not worried necessarily for the reasons you might think I'm worried, or necessarily what these guys are worrying about. And let me put it modestly different. Another line. This is the University of Michigan Consumer Confidence Survey, and it's worth noting it has absolutely plummeted over the course of the last 2 years. We had the initial hit from the pandemic. We saw a bit of rebound in consumer sentiment. And of course, over the last couple of months, it has now plummeted. And the Consumer Sentiment Index is basically where it was in the middle of the Great Recession. Now, that's intriguing. Let's compare a little bit about where households are today, where workers are today, compared to where they were in the middle of the Great Recession. For example, let's talk about labor markets. In the middle of the Great Recession, the job openings rate in the U.S. was 2%, whereas the unemployment rate was 10%. There were 5 workers looking for every job opening. Today, there's 2 job openings for every worker. And oh, by the way, that means, of course, that earnings growth right now is at a 30-year high, according to data from the Atlanta Fed, right? Here's something else that's different about the Great Recession versus today. Of course, that has everything to do with, shall we say, the enormous surge in the stock market and housing markets and everything else. Average U.S. net worth has increased by 25% in 2 years, from $300,000 to almost $380,000 per person in real terms in the last 2 years, as opposed to collapsing as it did in the midst of the Great Recession. And by the way, it isn't all just the billionaires. Actually, the 2-year growth of net worth of about 50% of households is up 90% in the last 2 years. Now, mind you, that's gone from being, shall we say, distressingly low to tragically low as a share of overall net worth in the United States. But clearly, everybody's benefiting at some level from where we are at this point in time. And yet people are angry. And this, to me, I think, is the greatest part of the story we have to think about, the thing in the back of our mind. It's not about the economy. The story is about us. Because people in this country are incredibly angry. Yet as far as I could tell from looking at the data, they have no reason to be. And that, to me, I think, is the defining feature of our times, this really scary devolvement into populist politics, where everybody is running around outraged about everything, probably because of a policy driven by the other party, and we're frenetically angry and upset, despite the fact that the data suggests that right now Americans are wealthier and have better job opportunities and better earnings possibilities than they've ever had. So it's a very strange world we live in, where things are really discombobulated. Now here's the big picture. How do we end up in this very strange place? Well, listen, obviously this all starts with the pandemic, but the pandemic is what caused the big shift. It really started pre-pandemic with, of course, all the negativity, all the constant conversations, what I used to call miserableism, this idea that everybody's really upset about how terrible everything is, despite the fact that the data suggests something completely different. That goes back to my 2012 to 2019 forecast. No, really, it's fine. Well, that's not the story in the paper. Now, the pandemic hit, of course, all that miserableism immediately got transferred into an existential panic. Now, there's no doubt that the pandemic was a tragic period of time. It was a tragic global natural disaster. Millions of people have died. That's not a good thing. But at the same time, natural disasters don't have long-run economic consequences. It doesn't take a lot of investigation of these type of circumstances to realize immediately that this is a different kind of business cycle, one that didn't have the same sort of long-run problems that, say, the collapse of the subprime bubble that has so overheated the economy from 2004 to 2007 had on our economy. But again, that wasn't the story. In that populist bubble called Washington, D.C., people lost their collective minds, and as a result, they threw $12 trillion in stimulus at the economy, $7 trillion in fiscal stimulus, $5 trillion in quantitative easing, $12 trillion. Now let me put that in context. From my analysis, you could argue over the last couple of years, we lost, roughly $2 trillion of economic output and about $1.5 trillion of consumption. So in response to $2 trillion in lost economic output, they did $12 trillion of stimulus. I mean, it's almost absurdly large. It's almost hard to get your head wrapped around how much money they threw in this economy for no particular reason. Now, I'm not saying they shouldn't have done anything. I always love that. Well, that's what people always push back. Well, they had to do something, right? Well, of course they had to do something. That's not the point. But what they did, of course, was so preposterous. What they've done is they've overheated the economy. What's amazing is the rhetoric out of Washington, D.C. still is wrapped around an economy in recovery, an economy that's incredibly fragile. Any basic look at the data tells us our economy is frenetically overheated. From asset markets to labor markets to earnings to interest rates to inflation, everything says this economy is overheated. And yet, they still have this weird idea that they are trying to help the economy recover. Well, that's just bizarre. Now, the result of that, of course, is we have an interesting future in front of us. You know, we keep hearing about this conversation about a soft landing. You know, when you overheat an economy, a soft landing is almost impossible. But while we have to be worried about the direction of the economy, it's not the panic you see in the papers today. This is the most confusing thing about it. What's the panic you see in the papers today? It's about rising interest rates. It's about inflation. Why is consumer confidence plummeting? It's because of rising inflation and rising interest rates. But again, inflation and interest rates are a symptom of the overheating economy. They're not going to be drivers of another contraction. That's not the issue right now. Now, at some point in time, what goes up must come down. At some point in time, yes, they're going to have to withdraw the stimulus. At some point in time, the Federal Reserve is going to have to confront the inflationary pressures it's created, and the only way it can do that is with a big, of course, dose of quantitative tightening. And boy, if you think long-run rates have gone up now, you don't know what you're talking about. When quantitative tightening kicks in, you're going to see long-run rates go up a lot. And that's going to change the conversation a lot. People are upset about mortgage rates of 5%. How about mortgage rates at 10%? Because that's what we're going to have to go through before we truly get control over inflation. And while we're at it, let's talk about the federal government, which is on a borrowing binge like we've never seen. Let me give you a couple numbers here. I have this in the presentation, but while I'm on a roll here, over the last 20 years, our government has borrowed, you ready for it? $60,000 for every single person in this nation. $60,000 per person in 20 years. By the way, that's $30,000 in the last 5. We borrowed $30,000 per person in the last 5 years. We have a $1 trillion structural deficit coming out of the pandemic right now. This is not sustainable. Now, again, at some point in time, we're going to have to face the fact that we've overdone it, and they're going to have to pull back, and that's going to be ugly. How ugly is it? Honestly, I don't know. You always look, people are like, well, what are interest rates going to be at the end of the year, Chris? What's the stock market going to be on March 14th in 2023, Chris? To which I say, if I knew that, I'd have a boat bigger than Putin's. And I wouldn't be in this room talking to you. I'd be living on my private island. Obviously, I don't know that. But what I do know is the level of economic uncertainty in front of us is profound. It's on par with what we saw, yes, in what I was feeling in 2004 and 5. I'm very worried about the future. But how this plays out, again, is a big mystery. What I do know is these folks who are calling the end right now have no idea what they're talking about. This economy's got violently more momentum than everybody's giving it credit for. Oh, sure, certain parts of the economy are pausing. Residential real estate is pausing. Yes, when interest rates go up, the market has to pause. But this pause is not a collapse. not with the kind of money floating around our economy today. But again, out there at some point in time, this thing's going to hit. And the longer it goes, the longer we deny the reality that our policymakers overdid it, the harder that landing is going to be when we finally get to that point in time. I just don't know yet. I just don't know yet. It's a beautiful part about my job. You have to keep inviting me back every single year, right? Now, of course, this is all mixed up with the changes that have occurred on a more long-run basis because of the pandemic, and not because the pandemic created any new normals. Oh, that stuff made me crazy. How many times did you read that article? The new normal, the new reality. Epidemics have been with humanity since we created our first village, okay? There's nothing new about this, and the history of humankind suggests that no, we don't live in caves post-pandemic. We don't. We're tougher than that. I get exhausted by this constant idea that human beings are so insanely mentally and physically fragile that we can't take a little adversity. We're a lot tougher than we give ourselves credit for, and we don't do ourselves any favor by pretending otherwise. But with all that in mind, there's no doubt that living in your house for 2 years has allowed, shall we say, the wheels of social change to move a little faster than they would have otherwise. And yes, coming out of this, whether you're talking about the great retirement and the labor shortages that are a critical part of every single local economy in this nation, whether we're talking about the huge movement of sales from, shall we say, typical brick and mortar to online centers, these are changes that were there already, but were accelerated by the pandemic, and the world feels very different. So if you feel unsettled, you should. There are a lot of things going on simultaneously. But again, you know, if I had to sum this up, if I had to just kind of give it to you in a nutshell, it boils down to this. No, it's not time to dive into your bunker just yet, but don't get too far from it either. Yes, it's probably going to be a good year, maybe 2 years in front of you, but at some point in time, it's very simple. If it's too good to last, it won't. And right now, it's too good to last. So be prepared for when the turn comes. Now, with all that, I've already talked vastly too long. I literally used half my time, and I'm on my third slide. So what I'm going to do here is I'm going to bolt through a bunch of these slides, try to back up what I said, and we're going to have a little time, I know, for Q&A afterwards. So let's just get into it. The wall of forecast shame. Here's some of the nonsensical headlines you saw 2 years ago. Scar the U.S. labor market for a decade. Home prices are going to fall. 30 to 40 million people are going to be evicted. 30% of people with home loans are going to stop paying. That's Zandy. Oh, boy. And, of course, one of my former colleagues at UCLA, I will never let him forget this headline. Make no mistake, this has morphed into a depression-like crisis. Like, it was never going to be that. It was never going to be this kind of downturn because it was a different kind of business cycle. Every business cycle is a little different. How large, what kind of responses, they're all different. First of all, this thing hit an economy that was fundamentally healthy. We could handle a shock to the system. It wasn't the mess that we all thought it was. The second big thing, of course, it was a supply shock recession, not a demand shock. What's a demand shock? Look, if you want to talk about the Great Recession, it's very simple. What happened in 2006? We all thought we were rich. In 2008, turns out we weren't. Now that, of course, balance sheet problem is huge. It's a huge issue for a nation because everybody has to rebuild the balance sheets, which means you save. If you save, you don't spend. If you spend, the economy doesn't grow well. If the economy is not growing well, it's hard to save. That's not what happened. This was a supply shock. What's the difference? In 2010, people didn't go to restaurants because they couldn't afford to. In 2020, they didn't go to restaurants because they weren't allowed to. What did they do instead? They did one of two things. They either took that money and spent it on stuff they could spend it on, because we are good Americans, and anybody who tried to buy a hot tub, a boat, a camper, anything that wasn't nailed down in the store in 2020, didn't exist. It was gone. It was bought. It was purchased. And we heard all the stories about the tragedy of the closed restaurants. We never heard about the bike shop making 4 times the profit it ever made in the past. If it bleeds, it leads. Don't put that good news in the paper. No one wants to see that junk. Or, of course, the other thing they would have done with it is move it intertemporally. Okay, we won't go to Disneyland this year. We'll wait 2 years and go. And by the way, everybody and their brother's trying to go to Disneyland right now. So, yes, it wasn't the same kind of thing. And, of course, you could see that in the data, U versus V. Why are we still debating this? It was a V. Aggregate spending, final demand we call it, got back to long-run trends in the middle of last year, 10 months ago. We keep talking about somehow or other nation still recovering. Almost a year ago, spending in our nation got back to normal. Now, GDP hasn't. But the reason GDP hasn't caught up is two reasons. First of all, the kind of consumption has been heavily weighted towards goods, which we tend not to produce as much of. We're more of a service-producing nation. And the other part is, of course, 3 million people retired. That means our capacity for economic output at some level has declined. So there's no surprise here. Again, what parts of the economy are going crazy? People stop spending money on services, they spend it on goods. What's interesting about this is not so much how much we are spending, it's how much we would spend if there was actually stuff available. How many times have you heard how consumers are getting crushed by inflation? Crushed by inflation. That's why there's not a car to buy in this country right now, because there's nothing available. Come on, that doesn't make any sense. You cannot say people are being crushed by inflation, but oh, by the way, there's 12 BMWs in the entire nation for sale. It doesn't follow. Look, the number of auto sales went down last year, not because there wasn't demand, but simply because they couldn't keep up with demand. We would have sold 2 million more cars last year had they been available. And you could see it in taxable sales, which has surged, crazy numbers there. Of course, U.S. production is at an all-time high level. Durable goods orders are at an all-time high level. Capacity utilization is back to level. No wonder we're having supply chain problems. No, it's not COVID. We're having supply chain problems because our economy was never designed to deal with this level of demand. Our ports weren't built to have this many boats be sailing in at the same time. We just weren't set up for this. And so, yeah, we're falling behind. But don't feel too bad, okay, for companies, because even though they're falling behind, corporate profits have leaped 20% in the last 2 years. Proprietor incomes are up 15%. Yes, profits dropped in Q1, but only from those incredibly high levels. Again, did anybody really think that corporate profits can grow 10% per year forever? That's not a reasonable idea. Now, business investment is back strongly. Venture capital, I mean, look at the numbers coming in, right? Crazy numbers coming into the Bay Area. San Jose, something on the order of $30 billion of venture capital poured in last year alone. By the way, services are coming back. You look at the TSA numbers, they're busy. Even without the Chinese whales, gambling in Clark County, otherwise known as Las Vegas, all-time high level, right? Yeah, Americans are getting crushed by inflation, which is why they are packing into every single casino in this country and gambling money like crazy. Because, we got to come up with the food money somehow, honey. I mean, it's just nuts, right? The things we talk about. Now it is. San Jose Airport's down. There's no doubt about it. The Bay Area is interesting because every number yet again says this place is on fire, except for it seems really quiet. So it's certainly an interesting time. We'll come back to that in just a couple of minutes. But again, even in services, yes, services haven't caught up, but I would argue it's a supply chain problem yet again. Now, in supply chains, of course, and services have to do with bodies, has to do with people. Before the pandemic, there was about 1.2 million job openings in leisure, hospitality, and other services. Today, there's 2.3 million. What's the problem in hotels? They can't hire anybody. Problem in restaurants, they can't hire anybody. It's a lack of people. I mean, I went to my favorite restaurant the other day, and it's closed 2 days a week now because they don't have the staff. So, again, it's a supply chain issue, not a lack of demand, as the case may be. So where are the people? Where are these workers? Well, yes, we have fewer jobs now than pre-pandemic, but that is not a problem with labor demand. Over and over, right? Every time someone wanted to talk negative, well, there's fewer jobs now. Yeah, that's true. But there's two reasons we could have fewer jobs now than 3 years ago. One is a lack of labor demand. The other one is a lack of labor supply. Now, typically it's labor demand, but it doesn't mean it's the right answer. Look at job openings, over 11 million, half again as many as pre-pandemic. Clearly, this is a labor supply problem, not a labor demand problem. Why labor supply? Long run, short run. The long run, of course, is basic demographics. Boomers all came out of families of 10 kids, they all had 1 kid. Our population pyramid turned into a population column. Boomers are now retiring. There's only basically 1.02 millennials to make up for every retiring boomer. So yeah, we were going to have a problem. But of course, it took the pandemic to really accelerate the issue, because look at all the people who are stuck at home. And you know, these are people who are already on the edge of retirement. And by the way, their stock market portfolio went through the roof. They refinanced their house at 2.6%. So what the hell? Let's just retire now. And they did. 3 million people dropped out of the labor force in 2020. That data goes back to 1947, just to get you the idea across to you that this isn't normal. People don't drop out of the labor force in the millions. Now, why did they leave the labor force? They retired. There's no... Newspapers are always trying to come up with some reason. They're afraid. They have long COVID. They're addicted to drugs. How about they retired? It doesn't have to be negative. And by the way, how do I know that? The current population survey. They ask people a question. Why aren't you in the labor force anymore? It's not I'm afraid. It's not I'm sick. It's I retired. Not a conversation. Now, if you're worried about income inequality, I have relatively good news for you. Your labor market solution has arrived. I had to show you the earnings are going up at a 30-year high pace. By the way, earnings for low-skilled occupations are now rising faster than for high-skilled occupations, because that's where all the shortages are. And of course, for workers in the bottom quartile of earnings, they have seen the greatest pace of earnings increase over not just the last 2 years, but the last 6 years. You always hear about the K-shaped recovery. This is the opposite of a K-shaped recovery, whatever it happens to be, because low-skilled people are doing absolutely magnificent. Now, mind you, again, if you're worried about income inequality, this is great news. If you're worried about running a restaurant, this is tough. This is tough. There's no doubt about it. Now, what about, of course, regionally speaking? You know, it's interesting. Everyone wants to play the comparative game. Arizona has more jobs now than they did pre-pandemic. California has fewer. Arizona's economy is strong. California's terrible. Whatever. Don't play the unemployment game. Don't play the comparative jobs game. I don't care where you are in this country. You go to any commercial street, you will see help wanted signs. The unemployment rate is a completely meaningless statistic at this particular point in time. It's absolutely pointless to even bother looking at it. And by the way, that means, of course, the story of economic growth moving from here on forward is no longer jobs, jobs, jobs. Remember, it used to be jobs, jobs, jobs? Well, now it's workers, workers, workers. Because really the places that grow their labor force are the places that are going to succeed in this new era. Now, what is going to allow you to grow your labor force? How do you go about doing that? Well, there's a couple basic ways you go about doing it. One is to encourage more people to move to your neck of the woods. By the way, how do you do that in California? It's very simple. It's called building more housing. Not complicated. Well, except for the actual do it, that's complicated. But the solution is relatively straightforward. By the way, there's also conversations about intensive. How do I get more of my existing population? What kind of programs can I have to encourage seniors to continue to work after even post-retirement? What kind of programs can I use to get more women into the workforce? Because the participation rate among women in the United States is the lowest in the developed world. Well, may I point to pre-K education? Now, it used to be that, you know, we kind of frowned on pre-K education because it was only good for the kid and the family, and that's just social policy, and we shouldn't do that. That was sarcasm, by the way. But now you can argue, of course, that it is good for the kids, good for the family, and good for your business because you freed up more people to go ahead and be available to work. So yeah, maybe now this is the time to do that more than ever. And then last but not least, of course, productivity enhancements. You know, 2 years ago, we were yet again devolving into that Luddite nonsense. Be afraid of technology. Be afraid of artificial intelligence. Millions of jobs are going to be stolen by computers. How many times have we gone through this nonsense? How many times? Here we go again. Well, now you could say, without any conversation, bring on the computers. Honestly, I tell a lot of economic development agencies, what you need to be doing here is you need to be working with your mom and pop businesses and telling them how to bring technology into your business to allow you to do more with fewer people. That is the solution to these problems, right? Now, for California, we have a problem, yes, with labor shortages, and it's because we don't build enough housing, you know, and In the late 80s, we were building 60, 70,000 units a quarter. In the peak of the Great Recession, we got to 50,000. This last decade, we never broke 30,000 per quarter. Incredibly small. Gavin Newsom, remember his big promise? There's got to be 3 million new housing units, and we haven't done a damn thing. And as a result of that, the labor force has basically not been grown at all. And if you want to talk about the story of California, yet again, it's a story of labor force, not a story of economic downturns and upturns. I mean, Stockton, Inland Empire, Sacramento, and Fresno all have more payroll jobs than they did pre-pandemic. By the way, for all of those places, their labor force grew over the last couple of years. Go down to San Francisco, Ventura, Orange County, they all have fewer jobs because their labor force has shrunk. So yes, part of this was the coastal areas got hit harder because of tourism, but also because the coastal areas got hit hard because that's where a lot of older, wealthier people live. And by the way, those are the ones who typically retire. See, the real problem we have in California that everybody keeps forgetting about is we don't just need housing to encourage more people to move here. We also need housing for retirees. In Indiana, when somebody retires, they're a good person and they leave. And in Pennsylvania, they leave. In Western New York, they leave. In California, they don't go anywhere. And yet again, you have to have housing for all those retired people as well as new workers. And we're just not doing it. Now, if you look at where the jobs are short, look, logistics came back like nobody's business, professional services, healthcare is back, information, manufacturing. Core jobs in San Jose are back. They've grown over the last couple of years. The problems, other services, leisure and hospitality, wholesale trade, these are parts of the economy that laid people off, and now there's nobody to rehire because those people took jobs somewhere else in the economy. So yeah, they're really stretching. There's a lot of problem just keeping up with demand. And again, it's all about growing your labor force. Now, San Jose actually over the last 15 years has done very well on that particular front. You know, it's interesting. Up until the Great Recession, it was really the East Bay that was building all the housing. Post-Great Recession, of course, the East Bay stopped building housing, and San Francisco and San Jose started engaging in more of it, and it has helped. The labor force here has grown pretty substantially, almost 12% over the course of the last decade or so. Very good numbers, but housing production has slowed, and with the retirement wave, yet again, there's a problem. And population is actually starting to shrink. So again, now more than ever, more housing needed than ever before. Now, I don't think, for example, you look at the net migration, huge net migration out in 2021. I don't think this is permanent. I know there are housing shortages here. I know this is a highly desired place to live. I think this was a reaction to the pandemic. My guess is people will start moving in. But again, there's going to be more sorting here. Even the conversations about work from home are going to be more intense here because it is a tech place and you're more comfortable with that kind of things. But at the same time, I also think that the death of the office has been highly overstated, to say the very least. Now, what about residential markets? Speaking of housing, where are they? Again, we were told they were going to plummet, prices were going to fall, and people were going to stop paying their mortgages. Instead, of course, they took off. Over 33% increase in home prices over the last 2 years in the nation. 33%. You could look at San Francisco there, about 34%. The numbers are just up like crazy. And now, of course, the market is cooling. Big increase in interest rates, no doubt. You see mortgage applications are dropping pretty sharply right now. But to be clear, I would be a little hesitant to call this the end of the housing. Of course, with big increases, housing permits have picked up finally. We've seen the greatest pace of multifamily we've seen in a long time. Why? What happened? Well, part of it's short term, part of it's long term. The long term is very simple. In the 5-6 years prior to the pandemic, the housing market finally, shall we say, fixed itself from the huge hole it had created in the midst of that run up to the Great Recession. And you saw homeownership rates about 2015 start to grow again. People started getting back into owner-occupied housing, as the case may be. But it was a very, very mild decade in terms of home production. And what's interesting is you see the huge surge in vacancy rates when the Great Recession hit. You see it on the right-hand side there. That was, of course, driven by the fact that a lot of homes, too many homes were being built, but they were being purchased basically by speculative markets. I mean, how many, you all remember the story of the adult entertainment in Vegas with 9 homes or something like that, right? Now, of course, when everything started to fall apart, all those homes got sold off, and suddenly we have this excess supply. A few years later, population, demand for housing caught up, but the housing market never picked up. It was an incredibly moderate overall pandemic. And really, the year before the pandemic, we had a record low housing vacancy rate in the United States. It was a very tight market. But then you have to understand the short term, because a real interesting question here is what was happening in the housing market in 2019. Because if you remember, it was incredibly cold, and that's when, of course, we were told that the U.S. might have a recession because of nothing else, of the housing downturn that was going on. Now, what's intriguing about this is I was taking this on even back then. It didn't make any sense. If you looked at the fundamentals, housing was in great shape. Tight inventories, clean credit, not a lot of debt. What are you talking about? But of course, it all boils down yet again to the gap between the narrative and the reality. The reality was housing was strong. The narrative people saw in the paper was that housing was on the edge of collapse. And so why would you go out and buy a house if home prices are about to drop 15%? How many people in 2019, can't even tell you how many people walked up to me and asked me this question. So Chris, when are home prices going to fall? Not, are they going to fall? When are they going to fall? Because we all know what's going to happen. And of course, my answer to when are they going to fall was, I don't know, never. Why would they? It takes a calamity for housing prices to fall. And this is a market that's about as opposite from being calamitous as any housing market could be. But everybody sat in the sideline. The story kept them out. And because they weren't buying, the market got even colder. Now we got into the pandemic. You're 6 months in. Suddenly interest rates, which had gotten up to 5%, dropped down to 2.5%. Suddenly your checking account is filling up like nobody's business. Suddenly, you realize you don't love your family nearly as much as you thought you did. Time for a bigger house. All right, fine. Even though prices may fall, I think enough is enough. Let's just go look. And they walked down the street, and they saw the line of 472 people with exactly that idea on that morning trying to see the same house you were. Let the bidding wars begin because the market was incredibly tight. Now, prices are going up like crazy here. By the way, they're going up everywhere. What's interesting about this particular housing cycle is it's not California-based. You look at California prices to the rest of the country, we're about the same. So everybody's seeing this giant increase in prices. There's nothing particularly unusual about it. Markets are still incredibly tight. There's 2 months supply out there. 2 months supply. Is it a bubble? Well, no, at least not yet. I mean, it looks a little frothy. I don't think the price increases we've seen are reasonable. But to be clear, let's yet again think about fundamentals. Decade of incredibly clean credit, both in terms of the growth in credit and the quality of credit. Thank you, Dodd-Franks. As for affordability, in 2011, 38% of California homeowners were housing cost constrained, spent over 30% of their income on housing. By the way, by 2019, that had dropped to 28%. Down, it dropped. Didn't go up, it dropped. I like to point out to regulators that, look, California housing is expensive for everybody except for the people buying it, which, by the way, is all you need to care about when it comes to these kind of conversations. And most of all, again, this is an equity-driven market. At the bottom, post-recession, take a look at the left-hand side, those bars. At the bottom of the market, post-recession, there was $8.3 trillion of household equity left in the United States. In the fourth quarter of last year, $26 trillion of household equity. Never has this nation had more equity. And by the way, an incredibly low debt-to-equity ratio. You think 5% interest rates are going to offset this market? No. 7%, 8%, not a problem. Yes, it's pausing, but $26 trillion is a lot of money, folks. And that's going to continue to flop around and continue to drive the market forward. No, it's way too soon to call the end of housing. High PE ratios, yes. Housing units per capita, yes, that's increasing speculative behavior. But there's two ways for PE ratios to solve themselves. One is for prices to come down. The other one is for earnings to come up. Now, earnings, of course, in real estate is rents. What about the rental markets? Well, we were told 30 to 40 million people are going to be evicted. I won't even go into the stupidity of that particular prediction. Needless to say, the rental markets in the Bay Area got hit harder pretty much than any other market in the U.S. outside of maybe New York. But it is increasing. Vacancy rates are dropping. Rents are starting to bounce back. Asking rents are starting to bounce back. And again, the Bay Area, got to remind you, is behind on this particular front. Most rental markets are taking off like nobody's business. Now, remind you that rental markets here were very hot ahead of time. Yes, there was a lot of stuff coming online just when the pandemic hit. I think because the Bay Area is so prosperous, a lot of folks here had other opportunities for housing, which they took, whether they were living in Incline Village or maybe out in, up north in the mountains north of Sacramento, or perhaps in some beautiful place in I don't know, Canada somewhere. They left, but they're coming back, and you certainly see the numbers. And in terms of affordability, as high as rents are here, I like to point out that the share of renters who are rent cost constrained in Santa Clara and San Francisco are some of the lowest in the state. You have the highest rents and the lowest shared of rent-constrained households because the Bay Area is so incredibly high income. So something to think about when you're worried about where rental markets are going. I wouldn't really worry about it. Now, I got to sum up, of course, where everything seems fine. Housing's going to pile through. People have lots of money. Labor markets are too tight. What's the problem? Well, again, it all goes back to the overstimulation of the economy. Take, for example, the $2.1 trillion of subsidies that the federal government packed into American households because of the pandemic to make up for about $820 billion in losses. Think of that. For every dollar of lost income, the federal government gave us back $2.50 in the last 2 years. That's nuts. That's just nuts. 2.5 trillion cumulative personal savings, 3.5 trillion in excess bank deposit accounts. It's just crazy. Now, mind you, there is no such thing as a free lunch. Yes, we feel rich. Yes, we have tons of money. But again, because of that enormous increase in government debt. Look on the right-hand side. You see the bigger amount of consumer debt before the Great Recession. Look how that's dropped from 120% to 80% of GDP. So consumers have cleaned up their balance sheet, but mainly, not because we cleaned up, but because the federal government basically picked up the slack. In 2004, we had a 60% debt to GDP ratio. Now we're 120%. $60,000 per American in 20 years, $30,000 in the last 5. What are we doing? And what's amazing about this is no one's talking about it. Well, this isn't sustainable. It's just not sustainable. It's amazing. I mean, and by the way, this is what they did, not what they wanted to do. Biden was pushing another $1.5 trillion stimulus plan into an economy that was already overheated. It just doesn't make any sense. And then, of course, Mr. Powell, not Dr. Powell, he's a lawyer. Now, I like lawyers. A couple times in my life, a lawyer's saved my rear end. But I wouldn't hire one to fix my toilet. Nor would I hire one to run my bank. But for some reason, we have one sitting on top of the Federal Reserve. Now, what did he do? Well, he just took, hey, listen, I'm not a lawyer, but I can read the playbook. I know what Ben Bernanke did. We have a problem. Quantitative ease, push federal funds rate down. And he did. Now, I think context is important here. Look, Jenny Yellen and Ben Bernanke did $3.5 trillion of quantitative easing over 6 years. This guy started with an opening bid of $3 trillion of quantitative easing, and since then has added $2 trillion more. Half again as much as Ben Bernanke did. Now, to be clear, Ben Bernanke was dealing with one of the greatest bank crises we've ever seen. This is one of the cleanest banking sectors we've ever seen. Back then, home prices were plummeting. They weren't growing at 20% per year. Back then, there were millions of foreclosures and bankruptcies. Today, there are none. What are you doing, sir? What are you doing? What crisis are you fighting? Well, he's not. Now, back then, because of all those financial problems, we had deflationary pressures. What's the difference between a recession and depression? Deflation. We had the big problem. We had to deal with it. We had to prevent deflation. $3.5 trillion of quantitative easing kept money supply growing steadily. Look how nice and steady M2 was right through the Great Recession period. Look at where we happened over the last 2 years. One of the greatest expansions of money supply we've ever seen in this particular nation. Now, of course, you throw all that money, what happens? Financial markets take off. You know, listen, San Jose's full of money. You're darn tootin'. $350 billion in venture capital investments last year. Twice what it was in 2019. Over twice. Now, pardon me for saying this, but do we really think there was a 225% increase in good ideas in 2 years in the United States? I don't think so. How about the stock market, which hit the second highest PE ratio ever outside of 2000? Hint, hint. You all remember that, right? How about cap rates that continue to plummet across the board? How about an insane number of commercial real estate transactions in the fourth quarter? How about home prices going up 30%? How about Bitcoin at $30,000? By the way, when it drops $30,000 more, it'll be back at its par value. Millennials, P-O-N-Z-I, look it up. I love this. Fed's Bullard. The monetary and fiscal assistance provided in response to the pandemic may have been excessive. Gee, thanks. By the way, first comment, not mine, but I couldn't have said it better myself. So, yeah, we feel rich. Sure, financial obligation ratio, lowest it's ever been. Greatest surge in household net worth ever. And of course, because of all that money, we're binging like crazy. Here's where I start getting really scared. Our trade deficit is now 5% of GDP. We borrowed $300 billion from the rest of the world in Q1. Our final demand output, rising up. These are scary signs. This is a nation getting ahead of itself. This is a nation that's spending out of control. Now, again, this can't last. Now, basically what's happened here is by, shall we say, tossing all this money at the economy, we functionally created an illusion of wealth where it didn't really exist. And because of that illusion of wealth that doesn't exist, everybody's trying to spend that money. And there's not enough output to go around. The equilibrating factor, by the way, is the inflation. We hear all the time, oh, consumers are getting crushed by inflation. No, consumers are causing inflation. Now, not all consumers. Some consumers are getting hurt. I get that. But to be clear, for every consumer being hurt, there's 4 others trying to spend like crazy. And until you address those last 4 people, you're not going to fix the problem for the first one. Now, it's not just here. Europe sees it. UK sees it. Japan's seeing it. Everybody overdid it. Now, the only surprise here, to me, is not what's happening, but why the Federal Reserve didn't see it coming. I mean, there's nothing. If you want to understand how inflation works, pick up Money Mischief by Milton Friedman. He wrote it in the early 1980s. I learned more from that 250-page book that he sold into the mass markets than I ever learned from my money and banking book in grad school. And he just lays it out. As soon as you overinflate the economy, money illusion kicks in, spending goes crazy, asset markets go crazy. But inevitably, you created a problem because there are more demands for goods and services than the economy can actually produce. Ergo, prices must go up to re-equilibrate, period, right? Now, everybody's talking about, for example, gasoline. I mean, come on. Really? $6 a gallon. So what? If you inflation adjust, it was the same price in 2011. And by the way, it was the same price in 1978. Let me go to the next step. In 1978, everybody had to drive cars that got 3 miles per gallon. Today, how many are electric? How many are hybrid? By the way, if you have to drive, I can't get my employees to come to work. Jeff Bezos will deliver anything your little heart's desires to your front door. Why is this a crisis? It's ridiculous. For me, the crazy thing is not the surging price of oil, but the surging dollar. A 10-year bond is going for 3%. Inflation right now, GDP inflation, 7%. Anybody who buys a U.S. Treasury is buying a negative 4% return. The dollar should be plummeting. It's going through the roof. You really want to know the problem with the Ukrainian-Russian conflict? The problem is it's basically blinded the global economy to what's going on here. And so they're pouring their money into the United States as a safe haven, despite the fact that, guess what? We're not a safe haven. Now, at some point, they're going to figure that out. Now, again, everybody's freaking out about inflation. Take a look on the left-hand side there. This is 5-year increases in consumer prices, okay? We've had 1 year of inflation on top of 4 of moderate inflation. That means over the last 5 years, prices have come up in aggregate about, 15%, about what it was in 2008. And of course, a far cry from where we are at the end of the 70s after the Fed's enormous mistake back then. It hasn't even begun. And yet we're flipping out about inflation. Everybody's upset about inflation. Give me a break, right? Don't be afraid about inflation that's happened. Be very afraid about inflation that's coming. Look, there's a basic metric, unit money supply, M2 divided by nominal GDP, all right? It's a good, steady metric. By the way, when you fire at M2, as high as it is, the only thing to re-equilibrate the money supply with actual output is the price level. If you look at money supply today relative to nominal GDP, it suggests, hold on to your hats, 30 to 40% more inflation. It's future inflation we should be freaking out about, not what happened over the last year. But no, that's not politics today. Remember, we live in the fragile economy where 75% of Americans are starving on their feet. One paycheck from financial disaster, homelessness, and starvation. Obviously not true. But that is the story. And so in that world, you make up excuses. It's supply chains, federal deficit, greedy corporations, not enough manufacturing jobs, bad green energy policies. Now it's Mr. Putin's fault. Well, what next? Saturn is in line with Jupiter. Disco's making a comeback. It's that new host on Jeopardy. They don't want to talk about it. Inflation is always and everywhere a monetary phenomenon in the sense that it can be produced by a more rapid increase in the quantity of money than output, period. Now, again, just take a look at where things are going right now. Yes, they're starting to increase. There's no doubt about it. But interest rates are still really low. Yes, the Fed's starting to move. But raising the federal funds rate, give me a break. It's nothing. They're chasing the long end of the curve. They're talking about quantitative tightening. They're going to start at $50 billion a month. There's $5 trillion in excess cash kicking around in our economy. $50 billion a month? They're not taking it seriously. They're not adjusting. So yeah, inflation's going to get worse. It's going to get a lot worse. And the only way to stop it is to kill demand. And the only way to kill demand is by driving real interest rate up sharply, and that's only going to occur when they start to sell off the bonds they filled up their balance sheet with, quantitative tightening. Now, when they do, it is going to hurt. Not because the private sector has a problem right now. In fact, the private sector is in good shape. Consumer debt is down. Consumer carrying costs are not that high. But remember, whatever the consumers got rid of, the government has picked up. And we have a lot of debt in this country, no matter how you look at it. The scary part is when high interest rates hits the federal government. We have a $1 trillion deficit. We're carrying $30 trillion on the books. They've gotten away with this in part because interest rates have stayed low. Federal debt payments to GDP have stayed remarkably constant over the last 2 decades, despite the huge amount of debt. Well, guess what? When interest rates start to go up, the carrying capacity is going to go through the roof as well, and then we all have to really worry about the secondary effect of a massive, of course, fiscal shock. That's the ugliness. Monetary tightening combined with fiscal shock, that's all going to cause consumers to have to rebalance their spending with their actual incomes and wealth levels, and that's going to create a mess. How much of a mess? All depends on when it happens. And while we're talking about messes, let's also remember what's going to happen here locally. Again, San Jose, huge number of high-skilled workers, premier companies, tons of capital flowing in here. Now we need the kind of technology produced more than ever because of labor shortages. You guys are on fire with 2 things you got to worry about. 3 things. One is, yes, the health of the overall economy. Number 2 is, where's all that venture capital money going to come from when all that money starts drying up? That's going to hurt. And then number 3, Gavin Newsom and company. $100 billion surplus. They're arguing. Of course, our assembly wants to spend it on social programs. The governor is going to be the adult in the room and only spend it on one-time things. Really? How about choice C? Don't spend it on anything. Because we've seen this before. This is all based on massive capital gains realizations, and when those go away, it doesn't just drop to a normal level, people. It collapses. In 2 years, 3 years, we're going to have $60, $70 billion state deficits. How about we keep the money for that? Oh, no, no. That idea goes nowhere in Sacramento. So, look, the economy's back. It was going to happen this way. It was a different kind of business cycle. Period. It was not an existential threat. It was tragic, but economically not a big deal. But of course, like everything in this country right now, everything turns into an existential crisis. We are a nation of 12-year-old kids where every single thing is the end of the world. Every single thing is the end of my life. Every single thing. We have no idea where we're heading because of our unwillingness and inability to grasp reality. Now, what's the forecast? Hot till it's not. No, we're not seeing the end. The negative number in the first quarter was nothing. Demand's still growing. There's phenomenal amount of money sloshing around this economy, and we will overcome the little changes we've seen so far. That's not the issue. But at some point out there, reality will kick in. Either inflation will get so bad that it'll force reality in, or we'll finally figure out that we got to get rid of some of this money. Interest rates will continue to rise. The fiscal power problems will start to hit. And eventually we're going to realize, not unlike we did in 2008, that we're not as rich as we think we are. And at that point in time, the piper will be paid. And at that point in time, we're going to know what a recession really looks like. 1 year, 2 year, 3 years, no idea. I would be remiss if I told you I had the answer to that. What I do know is the longer it goes, the uglier it will get. So yet again, don't jump in your bunker yet, but don't get far from it. Sorry I went a little long, but with that, I know we're going to have a little time for Q&A, and I'll turn it back over to the Dean. Thank you very much, everyone.
Thank you, Chris. It's great. Excuse me. We are going to run. We started a little late, so we're going to run just a little late. If we could raise the screen, please, and invite our two panelists back to the stage. We've got a little table set up, and to moderate, facilitate our Q&A is Derek Seaver. Derek is the San Jose Chamber's 11th president. He was there previously as an EVP. And also has served as Chief of Staff to Santa Clara County Supervisor Susan Ellenberg and as Director of Policy and Operations for the San Jose Downtown Association. Please join me in welcoming Derek Seaver.
Good morning, everybody, and Dean, thank you so much for the invitation. And the San Jose Chamber is really excited to be back and a part of this event. I know we were for a number of years prior to the pandemic, excited to be back this year, and really interesting conversations that preceded this. And I think a number of the questions that folks asked have been answered. But I did want to start with one that kind of summarizes a number of them. You know, Alan, you mentioned the decoupling of society and the economy, and I think, Chris, a number of your points were really about the narrative versus the numbers in the economy. And a number of folks asked, you know, how does that narrative change? You know, historically, there's a point where we do need to pick the optimism up a little, and I guess the question really is, how does that narrative change, and how do you build off of that? And Alan, I'll go to you first, and then over to Chris.
Are we on? Can you guys hear me? Great. That's a really complicated question, right? Because there's a fairly large hole. I think my co-panelists pointed out that you know, it bleeds, it leads. The media industry, which helps influence a lot of opinion, doesn't get paid for good news. And actually, anything we've learned about social media, it's actually fairly weaponizing on negative news and not too good on positive news. Fundamentally, narratives change when people change the narratives, and that comes from leadership. It could be leadership in government. It could be leadership in public. You know, look, the last year has been fairly positive for the economy. Nobody feels that way. I don't really have actually a great answer to that, because I think when people understand that they're doing well, to the point that was raised a moment ago, or they find something that binds them together, a sense of shared mission. As a country, probably the greatest moment in the last 25 years was the worst moment, which was 9/11, because there was a brief period of time for several years in our country when people kind of put aside their political differences and the narratives, and as a country, we come together very well when we're attacked. Interestingly, we had an opportunity during the pandemic, and we actually did kind of come together in a lot of ways. We didn't actually sell it very well. So I think it's actually going to come more from people leadership that are spend more time celebrating and bringing people together than exploiting their fears and anger. I don't know if you have a better answer. That's yeah.
It's interesting. Again, for those of you who've seen me talk before, you remember I would use that term miserableism to describe this disconnect, because for me it always was a bit of a mystery. And then about a year and a half ago, Robert Shiller, who won the Nobel Prize, wrote a book called Narrative Economics, and it was an epiphany, because his entire book was about what I was seeing. And he just made the broader point that economists start with this idea of rational humans, which means the data drives the story, which means you can ignore the story. And he said that, economists are fond at, shall we say, kind of looking down on the other social sciences because of their lack of formality, right? But in reality, people had stories, they've had narratives long before they had data. We're storytelling creatures. Our entire social structures are built around stories we told ourselves since prehistory, as far as we could tell, right? I mean, so the idea that somehow other people are rational and the story follows the data is a ludicrous assumption. And the history of business cycles is littered with, shall we say, evidence of how differences between the narrative and the reality can drive fundamental economic outcomes. And one of the things he talks about, for example, is the 20s were so roaring in part because the narrative of the 20s was a narrative of conspicuous consumption. Everybody knows the old Great Gatsby idea, right? And the narrative in the 30s went to the exact opposite. It went, conspicuous consumption was the thing. In the 20s, it was gauche, tacky, socially unwelcome in the 30s. And he makes the case that, intriguingly, it was the excesses of the 20s that intensified the shock, but it was the other side of it, that is to say, the narrative against conspicuous consumption, that kept savings rate vastly too high in the 1930s and caused the Great Depression to be much worse than it should have been, relative to the actual size of the shock. And so you start to realize that the narrative is critically important and has a dramatically role in history. And hence, I feel a lot more empowered to discuss the narrative relative to the reality and try to help people understand how the gap between those two things can shape the future. This, by the way, is an epiphany and still not seen in much of economics. And so the real question you asked me was, well, how do you change the narrative? We haven't gotten there yet. So
what he said.
Yeah, exactly. I don't know.
I don't know.
What you have to do is a couple things. First of all, I suggest everybody go out and buy 2 books, Money, Mischief, and Narrative Economics, and read them. Number 2 is understand the biases in the paper. Understand the biases of the economists in the paper. The people who are in the paper largely because they give good headlines. They just are. By the way, those reporters call me too, and they'll call me and they'll ask me a question, and I'll say, yeah, you got the question wrong and your answer is completely in a different universe. So let me explain to you how you got this all wrong. And as I'm walking through my reasoning, I hear the reporter becoming quieter and quieter and quieter. And I realize that I'm really screwing up this person's life. Not so much because I'm not giving him an interesting story, but it's not the story the editor told him to write. And every reporter, I say, is the child of divorced parents, their editor and their expert. And what that means is you have to be a better reader. We have a tendency in these busy times to skim headlines. Don't do it. Don't do it. Pick a few articles, read to the end. Reporters aren't trying to bamboozle you. It's the headline writer who's trying to bamboozle you. Be a smarter reader, find the reasonable people, stay away from the shrieking headlines. There is logic out there if you look.
Thank you both. I think we have time for 2 more questions, and I'll go, Chris, one to you first.
Well, I'll try to be shorter.
No, that's
sorry.
all right. It's all right. Chris, we'll go to you first, and then Alan, we'll wrap up with one to you. I think you touched on it a little bit at the very end of your presentation about the state. We had a couple questions about state and local stimulus.
Yeah.
But I guess to refine that question a little bit, because you did touch on it at the end, there are sectors of the economy that seemingly are recovering at least slower than other sectors of the economy.
No. Their problem is they can't find enough workers.
And
giving people more money to spend when there's not enough places to spend it at doesn't help anything. Giving renters rental subsidies when we don't have enough apartments only ensures rents go up more. You have to focus on supply, not demand.
And so to refine that question and to that point, the question was about, should the state of California, other states, be looking at assistance in those areas, the areas around workers, in any way?
No. Workers don't need assistance. There are more job openings than we've ever seen. Earnings are going up at a record pace. People are quitting at a record pace. I skipped by because I spent too much time talking as it is, but employees are taking jobs and not showing up for the first day of work. They're ghosting their potential employer. I don't think workers need help. But to your point, you listen to Sacramento, and again, the story constantly revolves around this enormous share of the California public who's on the edge of starvation and disaster. And those people don't exist in any sizable numbers.
It was a promise shorter answer. You delivered.
I'm trying.
No, right?
Yeah, no. Yeah.
Excellent. So, Alan, I'll wrap up on this question. So when they sent the list of questions over from the attendees today, one of them really stood out as being different from the rest, and I think in a nod to our host here today at San Jose State, we should ask it. One of the questions was, if I'm an entering college student today and I'm considering what to study and what career path to look at, what industries, sectors, areas would you recommend as being the industries that the future might hold that they should look at to study?
That's a very loaded question for me. I would start with a little bit of a preface. After 33 years in the tech industry, I've learned, and having had both great success and experiences at some of the most amazing tech companies. I worked for Cisco during its run, and I've had several startups that have had great exits. I've learned that you have a body of experience. The challenge is, as you get later in your career, you realize only about 50% of it is accurate, and the hard part is figuring out what 50% is right. So I'm always careful about advice. What I would say, rather than specific subject, I think there's some skills that people need to understand. The first one is everyone in our economy and everybody in their workplace absolutely have to become much more adaptive. In the old days, you picked a profession, you worked a line. I've had 17 jobs in 33 years, and I didn't job hop. That actually, so a lot of the skills, like you used to go to work at a good company and you do that, that's been irrelevant for decades. So the first thing is, are you bringing your education and your own mental state to a sense of adaptability, because everything in the economy is going to change. Second part that I would add to that, early in your career, when you have no risk or low risk and you don't have a family to feed or you have a mortgage, you should be taking more risks in your job choices and gaining experiences, as opposed, there's, I think, kind of a risk versus W-2 trade-off, that because you want to actually learn how to become more adaptive. And then the third one is that, at the end of the day, most of the economy is about building stuff and selling stuff. And you have to decide what side of that you want to be on. So here in the Bay Area, the front end of that has really been mostly about actually being a software engineer or hardware engineer and building stuff. Things are changing dramatically. And I would say that if you can understand the intersection of the IT industry and software and programming and hard science, Those are going to probably be the premium skills. And to the companies I spoke about earlier, the fusion of AI, which is just another term for software that thinks and learns. I mean, we can talk about algorithmic superiority and all that kind of stuff. And the industries that are going to go through severe transformation, when we talked a lot about healthcare, which is about a quarter of the economy, or agriculture, which is a large part of our economy, I think you have to start looking where other people aren't looking. So that would be my advice, as opposed to just necessarily doing the safe thing. Because in the short term, the safe thing is going to be great, but in the long term, it's not going to be too exciting. And I worked at IBM in the mid-'90s, and right after I was brought in with a wave of executives that Gerstner brought in to try to resuscitate the company, but it was an annual layoff fest. So it was effectively the Hunger Games of your career. And I realized that I loved the company. I had a wonderful job, terrific bosses, amazing technology, that this is not the playing field I wanted to be in, which is dividing up the spoils of this is yours and that is mine. So I think you need to be looking in your career in areas that have really solid growth, a lot of adaptability and change. And if you have the fortitude to move in that direction, you have a really high chance of thriving. That would be my answer.
Can I just want to say, because I love that answer, and I'm not going to disagree with it all, but again, I did ask this question a lot too, and when I tell people is, look, what you learn in school is by definition 5 years old, because you're going to get in the real world, it's going to be different. You're not going to learn too many direct skills in college. What you're going to learn is two things, and these are incredibly important things, as long as you choose the right majors. The two things you need to learn in school are how to solve problems and how to communicate. And I tell, so I don't care what your degree is, as long as it's a degree that's teaching you how to solve problems, and B, it's a degree that gives you an opportunity to learn how to communicate, both verbally and written. I have people come in with master's degrees in economics, and they can't communicate and they can't solve problems. And that's what you need to learn how to do. And by the way, for college students, that means taking hard classes, because the classes that actually make you think tend not to be fun. But that's how you end up in a good place.
No, thank you both, and hopefully the questioner is listening. Everyone, Alan Cohen, Chris Thornberg, one more round of applause and thank them for their time and expertise. I also want to thank once more today's sponsors and partners with San Jose State. The presenting sponsor, Bridge Bank. One more round of applause for them. Associate sponsor, Hopkins and Carley, and the media sponsor today, the Silicon Valley Business Journal. One more round of applause. And with that, Dean, I believe we are closed. And thank you all so much for attending, and look forward to coming back as a partner next year. Thank you all so much.